Hi, Matt McAleer, Director of Equity Strategies at Cumberland Advisors, just after the close on the 25th. What looks like a fairly benign week going out today at about the same levels as last Friday masks some pretty constructive trading activity. Whenever we see a nasty down day like Tuesday and Wednesday's morning activity met with demand, we chalk that up as a positive. That goes in a positive check column. So while we have to be patient here and let this market churn around at this 50% retracement level, there was some positive action underneath the indexes and averages this week. Mentioned last week that we had made up, the markets had made up about half of what they lost in that October to November area, and that 50% retracement area is a natural choppy ground. And that's what we saw this week. Constructive that there was a bid under the weakness earlier in the week. A couple things that we need to be aware of. If you recall back in December, we talked about the washed out weekly momentums reaching areas 0 to 5%, which is a figure we pay attention to on our analytics and on our technical indicators as a place to look for a snapback rally. We got as low as 2%. 2% of stocks on the New York Stock Exchange had positive momentum in late December. Right now, we're all the way up to 92%. 92% of the stocks on the New York Stock Exchange have positive weekly momentum. While that's outstanding for pricing action, we do have to be careful of any reversals from this level. So the opposite of what we were seeing in December momentum-wise, we're seeing now. We'll take it. Positive momentum is needed for pricing. That's great action in the stocks themselves, but it has gotten to an area that would normally be a natural pause and retrace and chop and test for demand. So we'll look for that over the next couple of weeks. Small caps continue to work well. Reminds me a little bit of last year when small caps came out of the gate strong, but were swallowed up by large caps, and small caps faded early, leading the U.S. Down. They were fading by summer, where large caps hung in till fall. What's working sector-wise is still a solid bid in technology. Healthcare hanging in. Biotech has a bid. Some of the nice things we have working. Areas that we'd like to see a little bit more of a bid, perhaps more on some of the equal weighted consumer areas to show that there's still good spending in that area. Over on the international side, no trades this week. We're sitting at about 25% cash. Emerging markets still dominating developed markets in terms of performance. We're thrilled with what's working in the portfolio. We'll just look to leg in at reasonable levels. Tactical, same type scenario, cash-wise. What's in that portfolio working very well as well. The key here is not to get into a chase mode with our cash in those portfolios. I feel confident that we'll get some reasonable levels to get that cash deployed over the next 2, 4, 6, 8 weeks. Chasing a V move off of a broken market is a recipe for losses. So we're going to be careful with that cash and try to find reasonable expectation levels, reasonable risk-reward levels going forward. Over in fixed income and bonds, same type of week. 10 years going out at about a 275 within a couple of basis points of last week. So we didn't see too much action in bond land. In terms of what we would look for going forward is to see if we still have that great valuation in munis versus taxable. Still have it today where municipals on the 20, 25, 30-year plane are actually outperforming in terms of coupon and yield taxable, something you don't normally see. Goes to how cheap munis still remain. So have a great weekend. We'll see what next week brings. We'll see you next Friday.